Mastering moving averages. Moving averages are the simplest yet most profitable indicator, but many don't know how to use them effectively. After over 150 backtests and 7 algos, here are 4 mistakes costing you money when using moving averages. I'm Manir, also known as Growstock Trades, and I also run unbiased trading. Let's get straight into this. First, let's go over the key uses. So before we dive into the pitfalls, let's revisit the main ways I normally use moving averages and what is commonly kind of known online. So first is going to be the crossover. So this is just when a shorter time frame or shorter term, so it could be period length as well. Moving average crosses over or below a longer term moving average, and this can be a signal shift of momentum, or sometimes it's just showing you basically that we're going from bullish to bearish. And this can be, this has been one of the oldest strategies really I've ever known. This is probably the one you'll see the most on YouTube. You'll see in old articles and things like that. And there was a time, back, like, I guess not that far long ago, but there was a time where these kind of simple strategies could really kill it in the market. And I think they still can nowadays, but they are definitely more of a long term and more of a sometimes what I would like to call like positioning sort of indicator. So if you're holding something for swings, then these can be really great. But if you're doing it intraday, most of the time it's going to get chopped up quite a lot. But let's get into the next use case. This is bouncing off. So this is normally when prices often trend and bounce off EMAs or moving averages, creating potential entry and exit points. Now, this is great, but we'll also come to learn how, a lot of the time price isn't trending. I think the statistic is something like 80% of the time price is not trending in normal indexes. So obviously on those trend days, this works insanely well, but on the other times, this can just be a lot of chop as well. Next is stacked moving averages. So this is using multiple moving averages with different period lengths that can help you visualize trend direction and strength. Imagine sort of like a roadmap where the widely spread AMAs suggest a strong trend while tightly packed MMAs indicate consolidation. And this can be, this can be sort of a bit of a better method compared to just a simple crossover or something like that. And this is something I've used actually quite a lot. However, we'll leave that for kind of like the next part where we really dive into the key mistakes that you want to avoid. And lastly, we have extension apart, or also like divergence. And this is when price action diverges from the moving averages, e.g. keeps rising while the MA flattens, or you can say it also between two moving averages as well. Personally, I prefer the second, which is between two moving averages and they're separating apart, creating that kind of extension apart. This can be a great sign to show for possible reversion, as moving averages are normally used for trend, but they can also be great for mean reversion. So first is the simple trap. So moving averages are a great way to start, but countless other types can suit your strategy actually better. To name a few, there's weighted moving averages, there's moving averages slopes, and there's whole moving averages. So don't be afraid to experiment. Research different MAs and backtest them and see what resonates with your strategy. As commonly just the normal MA is great, but realistically in a lot of my strategies I'm either using an EMA or sometimes weighted moving averages because they're just a bit better than classic moving averages. But obviously it depends on your strategy and the kind of outcome you're looking for. But I'd recommend experiment. Try different ones. It doesn't really take too long to try a different moving average. Most of the formulas are very simple and you can find them pretty much everywhere. And also benefit is they're normally on a lot of libraries or already coded onto as an indicator on a platform. So give them a try and they can be a really good way to find potentially better parameters or better indicators for your strategy. Next is overtrading. So using just one short-term moving average on an intraday chart can be a recipe for disaster. The frequent fluctuations, also known as chop, can lead to excessive buying and selling, eroding your profits, and also causing an increase in trading fees. Now, the solution to this normally is using multiple MAs. So combine a shorter MA with a longer one. The shorter can act as a filter, preventing trades during choppy periods. And then we have a second one, which is confirmation. So don't rely solely on moving averages. Look for confluences with other indicators or technical analysis tools before actually having that trade trigger. I would say if you want to keep it simplistic, we can normally stay with the multiple MAs method. However, if you're kind of creating easy examples like moving average and RSI, it's a really kind of classic combination. That can be great as a confluence if you're looking for that kind of mean reverting MA kind of trade. Next is overfitting. Now, MAs are incredibly easy to overfit. It's probably the most common mistake I see. As a rule of thumb, you should optimize quarterly. That does depend on the strategy and the market, but that's normally what I do in futures. And if your MA is something extremely specific, like 93.5, I think the craziest one I ever saw was like 73.55 or something. If your MA is anything like that, that is a huge sign to me that it is overfit. Why? Because realistically, if you did that on a parameter sensitivity, which means you're looking at the changes in that parameter and see how that drops off in performance for the strategy, I bet you would see 73.55 is like, the highest point, and then everywhere else is just rapidly dropping off on the sides. And that's not what you really want to see. You want to see a gradual decline from that parameter as you change away from the key parameter that you're using. So definitely look into parameter sensitivity, especially when you're using like MAs and really any indicator personally, but MAs is definitely a really classic one I see everyone overfit. Next is Confluence. So jumping in the second day moving average crossover happens can lead to false signals, especially during volatile periods, as we mentioned with CHOP. Now, the solution here is sort of similar to what we mentioned before, but I think there's a couple key things I really want to mention here. So obviously confirmation can be absolutely key here. So using a moving average as a potential entry signal, so instead of adding an extra filter, the actual moving average is the filter itself, by saying, hey, we're in maybe a position of bullishness. Now we're looking for other bullish signs. So let's, look for a low R sign on one of these dips and long there, as long as the other MA stays true. Stuff like that can be a really good way of filtering out of that kind of chop and also giving you nice direction in kind of trend markets. Whereas if you're looking for mean reverting trades, then you can actually say, hey, if they're between these two MAs, that shows that we're in, a point of mean reversion, which we should look for these other mean reversion characteristics and then, take those trades there. And the most important thing here is backtest it. Make sure you test this approach on your backtests. If you're on futures, I would say normally at least 5 years plus. If you're in small caps, 5 years should do just about. And this will really let you see if these are actually effective. Now, key thing when using these sort of indicators, do not just go, MA1, MA2, MA3, like on the period length. You will just overfit the strategy. I would say either base it off your own experience. So, obviously maybe you have a bit of look ahead bias there to some extent, but, experience can still tell you a lot. And to use common ones, I would say most of the time unique MAs don't hold as much power as common ones. So like 200, 50, 29. However, that is up for debate. That's just my personal opinion. But those were the 4 key mistakes that held me back for a very long time when using moving averages, and I've actually got one of my most profitable systems simply using a moving average slope, and that has been a killer strategy, at least for me, and incredibly simplistic. Now, by recognizing and avoiding them, you can really unlock the true power of moving averages, and I hope this video has helped. Thank you for watching, and if you enjoyed, please like and share it with anyone else who might be interested.